There have been many arguments to the age-old debate of what investing style is the best. Time in the market or timing the market. In this video, we are going to describe both strategies and potential underlying risks to help you determine what investing style would be best for you. Nick here from Ways to Wealth. Thank you for tuning in. It's week 50 of the market recap. And if this is your first time here, we highlight key events that happened in the market over the past week. And before we begin, I'd like to say a quick thank you to everybody who supported me on the last video. We killed the goal of 45, so I appreciate all of your support. And this week we're going to up the ante. We're going to 50. So again, if you learn something new, if you get some value out of this video, smash the like button. It definitely helps me out. And if you haven't already, make sure hit that subscribe button, turn that notification bell on. We do this every single week. There is so much to take into consideration if you're a new investor or an investor that has a large pile of cash sitting on the sidelines to put to work in this current market situation. On the one hand, you have the bulls saying that this is a bull run of the ages. You have interest rates at all-time lows. So equities, there should be no other place to look. And obviously with bond yields being so low, it's not like you're going to be able to generate income from that side of the portfolio. And then you have the bears. And the bears are simply saying we have not seen something like this since the tech bubble in 2000. This leaving many investors concerned both if they miss out on the bull run, potentially having that market skyrocket, but then on the other side, potentially losing double digits if the market were to correct. Before we get too far into the video, let's quickly break down what each strategy is. The first up, we have time in the markets. There is no better way to explain this than buy and hold. You are buying and holding on to your original investment, whether lump sum or dollar cost average, for the length of the portfolio, your invested time, whether that's 5 years, 10 years, 20 years. You're basically buying and holding, and you're not selling no matter what the market does. Next up is timing the market. This is based on the theory that you can sell at a market top and buy at a market bottom. This is basically referred to as buying low and selling high. For those relatively new to investing, this year has proven to be a great example for my first point, and that's the fact that the future is unpredictable. Earlier this year, we were hit with a black swan event, something that the markets could not predict. This in turn created markets to panic and fear the worst. If a market timer was able to avoid the rundown, they would have sold on February 19th, which proved to be the market top. They would have subsequently avoided a 34% rundown. And then in turn, if they were able to time the market low on March 23rd, they would be the beneficiary of a 64% run up we've seen from that day. Whereas the buy and hold investor, the one that did not sell throughout the market panic, would have had to wait until around November the 5th for the market to stay above its previous all-time highs in February, albeit still up nearly about 13% year to date. The sentiment in March was still one of extreme fear. The market started rebounding off the lows on March 23rd, leaving many investors as disbelievers. Who could have possibly known that this was the time to buy? The news was splattered with headlines of dead cat bounce, meaning that the market was going to quickly revert back down into negative territory. It was also cluttered with health news about how many new daily cases there were. This in turn highlights our second point, and that it's only human nature to succumb to your emotions. Okay, so let's say that investor does catch that top of the market, they sell, they're in cash. Who says they're going to reinvest at the right time? What if they potentially missed out on this V-shaped recovery that not many people have expected. Many pieces of research show that when investors panic, they often do not get back into the market right away and they miss those subsequent gains. The first example was a study done by Dalbar. They're a financial research firm, and they concluded over 20 years of data looking at the S&P 500 benchmark and an average investor's returns. And what they found was that the investor lagged the benchmark by about 4.66%, meaning that an investor would have done better if they just bought the S&P 500 and held over that 20-year period. Nobel laureate William Sharpe concluded in 1975 that a market timer would have to be correct in his purchases over 74% of the time in order to achieve better results than a passive buy and hold investor. He stated that the time and energy that it takes to do so would not be worth the reward, and even experts fail to outperform the S&P 500. Now, to the many day traders, I'm not here to bash market timing. If anything, this year has proven that market timing is beneficial. If you were in the tech stocks or in the stay-at-home stocks, I'm sure you are well outperforming what the S&P benchmark is doing. I just personally believe that psychology has such an impact on the decisions we make. You would need a systematic timing or some type of rules, a definitive, in order to make sure that your day trading or trading patterns stay consistent, whether that's being a buyer of stocks when that particular equity drops 25%. But with that being said, there is too much opportunity cost for missing out on that recovery. To give you an indication of what it looks like to miss out on the best performing months, to miss out on that potential economic recovery, we're going to take a look at Merrill Edge. They ran a study, and this study takes a look at the S&P 500 from 1990 through to 2018. One of the first things that they cover is that if $1,000 was invested at the beginning, what that would look like over the length of the portfolio. Passively invest, not touched, buy and hold. And they compared that. They compared that with a panic selling approach. So if that person with $1,000 were to panic sell and miss out on the top 10 performing months, what that would look like. They also took another thing into consideration to the nth degree, and they looked at the top 20 best performing months if that money was not invested. If you would have let that original investment ride over the 28 years, you would be up over 1,600%. And now if we look at missing out on the top 10 and 20 months, you can see that your investment at the end of the 28 years is significantly less. The pain and suffering of missing out on this economic recovery was very detrimental to the portfolio at the end of its life cycle. Here's another chart highlighting the cost of not being invested over the best days of the S&P going back to 1980 through to 2018. The cost of not being invested sitting in cash during even the 5 best days could be a very huge impact to the potential gain of your portfolio. Here's another chart that takes the S&P's data all the way back to 1928. And I personally like this one the best because it shows you what that market timing would do over the long run. So first and foremost, if you had bought and held shares from 1928 to 2018, you would effectively be up just shy of 6% on an annual rate of return. Whereas on the flip side, if you had timed the best 50 days and missed out on the 50 worst days, you would essentially be only just marginally better. Now, I'm not here to tell you if market timing is the right or wrong strategy for your personal investing style. If you have the right pieces in play in terms of stop losses and know when to buy and when to sell, then I'm not going to be the one to tell you what to do. I've just looked at the data over time, and it does not look like there is much of an advantage. And if you can take a lot of time risk out of the picture, then I believe that passively buying and holding the right asset allocation over time should be the best investment style. This is for people that don't have the time and energy to be checking the stock market on a daily or weekly basis. You just determine the type of risk that you want, allocate your portfolio in that necessary way, whether it's 60-40, 60% in equity, 40 in bonds, or whatever risk you want to go to. Buy and hold it, rebalance it on a yearly or a quarterly basis, and from there you should outpace the returns that market timers receive. Time in the market beats timing the market for me personally. And that's all for this week in the market recap. I hope you enjoyed the video. Again, I'd like to ask you a big favor. If you're still with me and you got some value out of the video, give me a big thumbs up. I appreciate that. And don't forget, hit that subscribe button, turn that notification bell on. We do this every single Sunday. I hope you all have a great week in the markets. Happy trading.